In 2026, a quiet financial revolution is unfolding behind the scenes, and most people have no idea it is happening. Central banks across the globe are steadily reducing their dependence on traditional, paper-based reserve systems. Instead, billions of dollars are being redirected into gold and alternative reserve assets. At the center of this transformation stands the growing influence of the BRICS nations. What began as an economic alliance is increasingly shaping discussions about the future of global reserves. The question is no longer whether reserve diversification is occurring. The real question is how far this movement could eventually go. To understand the shift, we first need to examine how central bank reserves traditionally worked. For decades, reserve portfolios were heavily concentrated in major international currencies. These reserves helped stabilize exchange rates and facilitate international trade. But economic uncertainty has encouraged many policymakers to reconsider concentration. Risk diversification has become a central theme in reserve management discussions. Gold has emerged as one of the most closely watched beneficiaries of this trend. Unlike paper currencies, gold carries no direct issuer liability. That characteristic has attracted renewed attention from reserve managers worldwide. Several emerging economies have steadily increased their gold holdings in recent years. Supporters argue that gold provides an additional layer of reserve resilience. Critics point out that gold prices can still experience significant fluctuations, yet reserve managers often focus on long-term strategic objectives rather than short-term market swings. Gold is only one piece of a much broader reserve diversification strategy. Some countries are also exploring increased use of local currencies in cross-border trade. These diversify settlement options. The BRICS discussion has therefore become much larger than a single currency proposal. It reflects a broader conversation about flexibility, resilience, and financial sovereignty. And as reserve policies evolve, the decisions made today could influence the global financial system for decades to come. Behind closed doors, central bank committees are reassessing assumptions that remained largely unchanged for generations. The objective is not necessarily to abandon existing reserve currencies overnight. Instead, many institutions are seeking greater optionality in an uncertain world. Geopolitical tensions have become one of the major catalysts behind reserve diversification. Financial sanctions have highlighted the importance of reserve accessibility and control. As a result, reserve managers are increasingly evaluating where and how assets are stored. Physical gold offers a reserve asset that can be held directly within national vault systems. That feature has become increasingly attractive during periods of global uncertainty. Another important factor is the gradual evolution of international payment infrastructure. New settlement systems are expanding the range of available transaction channels. These developments allow countries to explore a wider variety of trade arrangements. Energy exporters are paying particularly close attention to these emerging frameworks. Commodity-rich nations often view reserve policy through a strategic, long-term lens. For them, reserve management is closely linked to national economic security. This explains why reserve diversification discussions often extend far beyond investment returns. Gold purchases by central banks have attracted significant attention from global investors. Many observers interpret these acquisitions as signals about long-term reserve priorities. Yet, reserve diversification is occurring across multiple asset categories simultaneously. The trend reflects risk management rather than a single uniform strategy. Different countries face different economic realities and policy objectives. Some prioritize trade efficiency while others emphasize reserve independence. The BRICS conversation therefore encompasses multiple overlapping financial goals: trade settlement, reserve diversification, and financial resilience are all part of the discussion. The outcome could influence capital flows, commodity markets, and international trade patterns, and the world is watching closely as the next chapter of reserve evolution continues to unfold. While headlines often focus on dramatic predictions, central banks typically move with remarkable patience. Reserve allocation decisions are usually guided by long-term stability rather than short-term market excitement. That is why even small portfolio adjustments can carry enormous significance. When reserve managers rebalance assets, markets pay close attention. Investors often search for clues about future monetary trends. One area attracting increased attention is the relationship between reserves and commodities. Commodities have historically played an important role in international economic systems. Today, resource-rich economies continue to evaluate how those assets fit into strategic planning. This discussion extends beyond gold to include energy, industrial materials, and critical minerals. The global reserve landscape is becoming increasingly complex and interconnected. Technology is also reshaping how central banks think about financial infrastructure. Faster settlement networks are reducing friction in cross-border transactions. Greater efficiency can create new opportunities for trade and reserve flexibility. As these systems evolve, policymakers gain access to a broader toolkit. Flexibility has become a valuable asset in an unpredictable economic environment. Supporters of diversification argue that spreading risk strengthens resilience. Critics counter that excessive fragmentation could reduce efficiency. This debate is likely to continue as the reserve system evolves. What remains clear is that diversification has become a permanent feature of policy conversations. Few major institutions are ignoring the subject entirely. Even countries with different priorities are studying similar questions. How much diversification is appropriate for long-term stability? Which assets offer the best balance between liquidity and resilience? And how should emerging technologies fit into future reserve systems? The answers to those questions may help define the next era of global finance. History shows that major shifts in the international financial system rarely happen in a single dramatic moment. More often, transformation occurs through countless incremental decisions made over many years. Each reserve adjustment may appear modest when viewed in isolation, yet collectively, those adjustments can reshape global financial behavior. This is precisely why reserve diversification commands so much attention from economists. The implications extend far beyond central bank vaults and treasury offices. Reserve policies can influence borrowing costs, investment flows, and trade relationships. They can also shape how countries prepare for future economic challenges. That makes reserve management one of the most important responsibilities within modern central banking. The BRICS currency discussion should therefore be viewed within this broader strategic framework. It is ultimately a conversation about options, resilience, and adaptability. Gold remains a prominent part of that conversation because of its unique monetary history. Alternative reserve assets continue gaining attention as policymakers evaluate future scenarios, and technological innovation is expanding the possibilities available to decision makers. Together, these forces are creating a more diverse global reserve environment. Whether this evolution accelerates or slows will depend on future economic conditions. It will also depend on geopolitical developments and policy choices around the world. What is certain is that reserve diversification is no longer a niche topic. It has become a central issue in discussions about the future of global finance. The decisions being made today may influence financial markets for years to come. Investors, policymakers, and institutions are all watching the trend closely. The story is still unfolding, and many chapters have yet to be written, but the direction of travel suggests a growing emphasis on diversification and flexibility. Understanding these developments may become increasingly important for anyone following global markets, because the future of reserves may help shape the future of the global economy itself. This content is for educational purposes only. It is not professional financial advice. Investing involves risk. Always do your own research.